Welcome. Thanks for joining us for this webinar on raising capital, structuring, and administration for fundraising and the benefits of SPVs. My name is McKenna. I'm an editor with Utah Business, and I'd like to extend a huge thank you to Jeremy Nilsson, co-founder and CEO of Assure, for leading this webinar today. Before I turn the time over to him, I just have a couple of housekeeping notes. First, this webinar is being recorded and it will be uploaded to utahbusiness.com by the end of the day. So if you go to our website and click on the events tab in the header, you'll be able to find it there. Or if you search webinar in the search bar, you'll have access to our entire library of free webinars. So make sure you do that if you're interested, but you will be able to watch this one over again, send the link to your colleagues, whatever you'd like. Lastly, we will be hosting a Q&A to wrap up this webinar, so feel free to type your questions into the discussion box during the webinar at any time, and at the end I will read them for Jeremy to answer, so stick around. Without further ado, I'll turn the time over to you, Jeremy.
Great, thank you. So I do have some slides, so if you could allow me to present, that would be great.
Oh yes, of course.
So let me get started with a little history. How did we get to where we are today? If you're not aware, I think most people joining this probably are aware, there has been a sea change when it comes to private asset investing. What I mean by that is that things are very different today than they were 10, 15, 20 years ago. And what we're going to talk about here today has a big part to do with that. But, giving a little bit of background, a little bit of history, I think will be quite interesting. So when I launched the Utah Fund of Funds in 2005, the status and the environment of investing was that a diversified portfolio would be comprised of public stocks, some bonds, maybe a little bit of real estate, and that would be it. You would rarely ever see any sort of private asset investing, startup companies, secondaries, venture funds. None of that was on people's radar. There was multiple reasons why that was the case. But over the last few decades, there's been this change as to understanding the value of private assets and investing into private assets. So when I was running the Utah Fund of Funds, when you talk to institutional investors, groups that had money that were investing, they might have around 5% of their portfolio focused on private assets. And they would go into a couple venture funds, a couple buyout funds, and that would be it. And they would say, you know what, this money is meant to be either a grand slam, 10x, 100x, or it's supposed to go to zero. I'm not relying on it. And there was a particular fund manager, a David Swenson, during this time that I was at the Utah Fund of Funds. He was a former Yale endowment manager, and he was crazy. Everyone thought he was crazy. He took over this endowment when it was $1 billion in AUM in 1985, and he went heavy into what they would call alternatives or private assets, going into venture capital, going into private equity, and he was having fantastic returns. After a time, everyone started to turn and look and say, what is going on? He was a big proponent of private assets, and he grew that endowment to $31 billion. So this model that he was using was starting to perk everybody's interest. And so, private markets are becoming or have become the new public markets. And so, basically this new reality that everybody's waking up to, they saw Swenson do it, and they're starting to watch and realize. And what's happened is that what used to happen in the public markets are now only happening in the private markets, which is alpha. If you're investing into anything, you want it to increase in value. And they want this difference, this alpha difference is what everybody's seeking for. And they were finding out over time that all of the alpha growth in investments was happening when the company or asset was private, not when it was public. To give some tidbits here, some data behind it. In 1986, Microsoft IPO'd, and Microsoft's valuation at the time was $777 million. In 1997, so 11 years later, Amazon IPO'd, and their valuation was $438 million. Today, both of their valuation is near or past the $2 trillion mark. So all of that growth happened in the public markets. So basically, you didn't need to buy Microsoft when it was private. You just wait for it to go public, and then you received all of that growth when it was public. That's no longer the case today. And so, some examples of that, if you have been following, Robinhood's IPO in 2021 had a valuation of $32 billion. If you compare that to Microsoft's valuation of $777 million, or Amazon's valuation, $438 million. Robinhood went public at $32 billion. So all of that value of them maybe going public at 500 million up to 32 billion, all of that alpha, all of that value was captured by the investors in the private side of the investment, not the public side of the investment. Other examples, Palantir's 2020 IPO, they were valued at 20 billion. Uber's 2019 IPO value, 75 billion. And a company that's still private, SpaceX, is valued at $74 billion. So all of that alpha has been captured by those people, groups, and individuals that are invested in that company that is on the private side of the line or the equation. It has been estimated that 3.5 times more capital is allocated to the private markets today than it was just a decade ago. And why is that? Alpha, returns. Research has shown that institutional investors that have the largest allocation to private markets have had the best returns. So just like Swenson did it with Yale 20 years ago, it's just accelerating where it's now not just one person, but two, but 20, but hundreds, thousands and millions of people are showing that investing in private assets are delivering wonderful and amazing returns. So again, why this happened? Sarbanes-Oxley is one of those things that happened. When the federal government put more and more regulation on public companies, private companies did not want to go public. They wanted to stay private. It was too painful, too expensive, too difficult to be public. So why not stay private? And if you did not need to go public to raise money, if there was plenty of money coming at you, then you didn't need to go public. So increased regulation for public companies. And then at the same time, there was a decrease in regulation for private markets, private assets, private company investing. So you saw the two lines basically cross, where it's no longer interesting to go public. I don't need to go public. I don't want to go public. Oh, and I can stay private and I can have money and it's easier, simpler, smoother. I'll just stay private. So now that sea change, that flip, I need to be investing into private equity, private assets, private companies, not wait for them to go public. When I was at the Utah Fund of Funds, one of the companies that we invested in was a local fund who basically they were experts in small to mid-sized public companies, and they saw this happening, and they created a venture fund in order to get exposure to these private companies back in 2006, 2007, when they saw this sea change happening. So in addition to kind of money, regulation, returns, you always have to have something to invest into, right? So is there actual great private companies to invest in? And, as things happen, if certain things change, certain things are interesting, certain opportunities, then you'll see a large movement into that space. And entrepreneurs are the central figure of this entire thing, which is, right, if Bezos didn't start Amazon, then there would be no Amazon to invest in. And so this entrepreneurial need to fill the void was also a part of the ecosystem and part of the equation. And the two big events that occurred was the .com, which was the internet invention, all of the innovation, technology improvements that came from that. And then there was the great financial crisis, or the global financial crisis, 2007, 2008, when 9 million jobs were lost. And there was a large number of people who said, well, why don't I just start a company? Right? This is a moment for me to do that thing that I thought I might want to do. And so a sampling of the companies that were launched in 2008, 9, 10, and 11 include WhatsApp, Uber, Airbnb, Slack, Venmo, Pinterest, Warby Parker, struggle with that one, Impossible Foods, Snapchat, Square, DraftKings, Duolingo, Beyond Meat, SoFi, Honest, right? And the list goes on and on. And so as these events have all happened, as alpha has been found in private markets, as government regulation has made it harder to be public, this sea change, this movement into private assets has accelerated immensely. A couple other things to point out that has been happening over the last 10 to 15 years that have made a big difference in this sea change. Accelerators emerged. So, entrepreneurs become, they start companies, the companies grow, they become valuable, they become interesting, they turn into Amazon, they turn into Microsoft. So how do you provide services at the very earliest level to encourage, help, and accelerate company growth? And these things were not available in the past. All of these services, all of these resources, all of this expertise was not aggregated, was not available. Accelerators started around 2005, where groups and individuals could come in and receive world-class accelerated training and then receive capital and investment and marketing and PR. Was never there. It was something you just had to figure out on your own. Other things were support network groups. These various networks like the GAN network and Startup Grind and Google for Entrepreneurship program. All these programs to support and encourage entrepreneurship were things that started in 2007 and later. And then the rise of angel investing. Individuals or groups that made a lot of money during the .com. Individuals that had money just in the bank account. Individuals that thought, you know what, I'm going to invest in startups. Haven't done it before. I'm just going to do it. And there was this kind of early wave around 2007, 2008. They called them super angels. These were individuals and groups who basically bucked the perception that angel investing is too risky. You don't do it. It's kind of a fool's errand. You only do it to kind of be altruistic or socially minded. They're like, no, absolutely not. This is where money's made. And those very early investors started to invest into Uber, into Twitter, into Tumblr, into these companies. And then as those companies went public, everyone's like, whoa, that's interesting. And there's not a large number of Ubers and Amazons and SpaceX, but there are enough. One interesting stat that I've seen is some of the earliest investors in Uber who put in $5,000, $10,000, walked away with $100 million. from that one investment. So those types of realizations, those types of real life events really allow other people to be like, wait a second, there's something seriously important here. And in addition to those things I've stated before already, regulation, alpha, understanding, entrepreneurship, support systems, and great stories, was the private investing world was starting to become demystified. Up until a certain point, it was really black box. It was really rogue, very kind of unknown, and it's kind of strange, really risky. They're only doing that because they can't get a job on Wall Street, those types of attitudes. And because of the internet and other things, a couple of things started to happen. Social media platforms happened, blogging happened, certain key features happened. And so in 2003, Fred Wilson, who's now an iconic venture capitalist, he launches Union Square Ventures and starts blogging, starts typing about views, situations, ideas, examples. And people are like, whoa, someone's actually saying what's going on. Before only 100 people knew this. Now one of those 100 is telling everybody what's going on. And we're able to read in depth into that world, and a looking glass into that world. 2011, Brad Felt and Jason Mendelsohn published the Venture Deals book, where they kind of demystified the venture investing into companies. 2010, Naval launched Venture Hacks, which turned into AngelList. An AngelList called Assure, called my co-founder and I, and asked us if we could figure out how to do funds in bulk. And that's kind of how we get to today with Assure. And kind of there's that aspect, that thread, that seam through this entire sea change, where private investing has now been extremely popularized and extremely important to most everybody in the investing and startup ecosystem. Two or three other things I want to point out: some other rises of information or some innovations. So transaction speeds go up and deal friction goes down. This is kind of around that private asset deregulation and innovation. So there's been multiple legal innovations around private asset investing, particularly in startups. The rise of the convertible note. There was this huge issue around angel investing into startup companies. I remember when I was at the Utah Fund of Funds, there's this real angst around how do you invest in a really early company? Two individuals in a garage, two women who have just created something that it's got some early traction. Like, it is, how do you do that and not consume the entire company's cap table? The valuation, how do I set it? And basically people were not investing because they couldn't come up with the solution. So a convertible note solved that problem, basically saying we are going to defer the valuation of this company until a future point. Here's some money. And that changed a lot of the decisions, took a lot of the pressure and frustrations off the table. The innovation of the convertible note changed into the innovation of a safe. And basically they took all the aspects of the convertible note and tried to improve upon it. And they did improve upon it in some aspects. Others, there's this fun debate about if it's greater, better, worse, better, whatever it is. But it's an innovation on top of the convertible note. And then just more and more innovation, right? Like DocuSign, like signing documents digitally. That makes things move faster. And today in the VC stack, if you will, there's over 200 technology companies that allow things to move quicker, better, faster, smoother. And so with that, I'd like to share my screen and walk through a few slides. So with that background, raising capital, structuring, and administration. I mentioned Assure briefly. We provide the structuring and admin services to a large number of clients, helping them do pool investors into a structure so they can invest mainly in startup companies, but anything else, secondaries, real estate, art, film, any of the private assets that people are looking to invest in to generate alpha. So we have closed over 7,000 SPVs. We have over 8 billion in AUM on these SPVs. We have almost 1,500 clients. Just a quick little fun stat. We've sent money back to investors that invested into these companies through SPVs, over 800 million since January 2020. Now, if you're going to invest, so I've talked about the big history, this umbrella, if you will, this kind of background, sea change, this stuff's new. So let's talk about today. Investing in private assets, very interesting. A lot of people are doing it. It's where you find alpha for a lot of people. The amount of money going into private assets is growing almost exponentially each year. And there's predictions that that's not really slowing down anytime soon. And so how do you do it? How are people doing it? What's the process, structure, all that stuff around investing into private assets? One thing I just throw out quickly is, there is regulation around this. Accredited investors are required. You have to basically be rich, $200,000 in annual income or $1 million in the bank, that type of stuff. So there are some restrictions that are there, but there's a ton of innovation happening on that front on a daily basis. And just like there's been all the innovation I just talked about, I believe that the innovation around who gets to invest in private assets is moving in a very accelerated pace, and that'll be interesting to watch. But let's say you find something you want to invest in, you want to get into the space. How are people doing it? There's two ways, and only two ways, that people invest into private assets. It's going direct, or it's going through a structured vehicle. Going direct is when you go into your own pocket and pull out your own money. Example would be, let's say you talk to a CEO, she's amazing, her team's amazing, you want to invest, you have a bunch of money in your bank account, you talk to the CEO, say, I have $50,000, CEO says, great, love for you to invest. You write a check out of your own personal bank account, hand that over to the CEO. That's going direct. Any other behavior besides that one is going through a structured vehicle. And a structured vehicle is when you're setting up a legal entity like an LLC, you're getting documents for that entity, you're getting an EIN, and we'll talk about that more here in a second, but you're doing this structured vehicle. And structured vehicles have hundreds of names. They've branded these structured vehicles, SPVs, VC fund, real estate fund, sidecar fund, venture capital fund, real estate fund, pledge fund, like on and on and on. Those are all structured vehicles. These labels or wrappers are really to try to describe what that structured vehicle is going to do. Like a venture capital fund, we do venture capital investing. A real estate fund, we do real estate investing. Special purpose vehicle, we're going to do a one-off deal by deal structured vehicle, right? So all of these wrappers that you may hear out in the marketplace are just branding wrappers around a structured vehicle, which basically all look almost identical. So I described going direct quickly already. You decide, you're going to sit on the cap table, you manage this investor, it's all you. Many times that's the perfect and a great way to go about it. But there's not always, but there's some cons that we'll talk about in a second. Traditional VC fund is the other most common structured vehicle. And this is where you're going to set up a venture capital fund. You're probably going to have a team. You're probably going to have pretty heavy administration. You're going to pool people's money into this venture capital fund. You're going to invest that into assets. You're going to manage this portfolio, and individuals are going to get a piece of each of those investments through that investment. And the other structured vehicle are SPVs. So in the world of private investing, there's really going direct, kind of a venture capital fund, and SPVs. Those are really the three core elements of investing into private assets. SPVs are typically deal by deal. So a venture capital fund is the managers, the GPs will come to you and say, hey, I'm going to raise a venture capital fund. You say, what are you going to invest in? They'll say, we don't know yet, but we know it's going to be SaaS and AI and, out of Silicon Valley or something, right? There's a thesis around it. And you can say, I like that thesis. I like you. Here's $1 million. And then they'll take it and they'll do what they want with it, within the thesis, and they'll tell you what they've been doing, report back to you. An SPV is somebody saying, I have access to an asset. I talked about SpaceX earlier. It's still private. So someone would come and say, hey, I have some shares into SpaceX. Would you like to invest? So an SPV is very narrow. It's known, very transparent. You get to know what's going on. You make a decision. You know exactly what you're buying. Venture capital funds called blind pool for a reason. It's blind to you. They're going to make the decisions. They'll let you know what they did. SPV is called transparent. It's a transparent fund. You get to see and decide before you put your money in. So direct investing, pros and cons. Pros, you get to sit on the cap table, you get control, like it's just you get to control it. You perhaps get to have that opportunity of the relationship, the knowledge, all that stuff, the relationship. Cons typically are minimums are very high. A CEO doesn't want you to write $1,000 check. They want you to write $100,000 check, maybe a $1 million check. So minimums can be quite high. And then, you need to manage all the stuff going on. Every time that company wants somebody that is on their cap table to sign something, they're going to send it to you. You have to deal with it. You have to make the decision on the due diligence. It's all you. And maybe those are pros, right? So some of these can feel like pros or cons and vice versa. I talked about this already of just kind of the spectrum of assets. And when you have a structured vehicle spectrum here, the traditional VC fund is going to be in your bottom left, your SPV top right. The behavior or the requirements or the work with regards to these two structures are very different. A venture capital fund, expensive to set up, expensive to manage, expensive to run. An SPV is going to be much simpler, much easier, much affordable, quicker, simpler, transparent structure. Not saying one's better than the other. I like SPVs because that's what we do. A lot of people love venture funds. Just understanding the differences is important. These other two in here, multi-asset SPVs, micro VC fund, is what you're seeing in the marketplace is innovation. Just like we've kind of talked about at the beginning, there's tons of innovation with blurring of the lines where people take most of the elements of an SPV, add one venture capital element to it, tweak it, becomes a multi-asset SPV. A micro VC fund starts to look much more like an SPV, but has elements of a venture capital fund. There's a lot of graying in the industry as a lot more money flows in, a lot more interest flows into the private asset investing ecosystem. That went too far. Go back to this one. Okay. Pros and cons of a venture capital fund. Pros would be that you're in a fund that has a lot of money. They can invest in these companies. They have reserve capital to manage all these investments. It's professionally managed. You have great, wise people that you trust. They have a lot of experience. It's kind of this great, you only write one check. They're going to give you a diversified portfolio. And so So there's a lot of great elements of putting your money in, having the trust and confidence of those that are going to invest the money for you. Cons are that there can be high expectations. If it's blind pool and I'm just giving you money and you can do whatever you want with it, I want a lot of checks and balances, which then results in heavy administration, audits, financials, reports, which is appropriate. It's a little more complex. There's going to be high minimums. A venture capital fund only has so many seats, and these are back to regulation stuff. They can't raise money from 1 million people. The SEC has put restrictions on how many people they can take money from. And so that in turn basically drives minimums. If there's only 99 seats and I want to raise $100 million, everyone has to put in on average over $1 million. Maybe one person puts in 10 million, another person puts in 100,000, but minimums are going to be high. The other thing, again, is it's blind pool. You don't get to see what's going on. You really don't get to learn much either. You kind of watch from afar what they're doing and being a part of it by just getting their reports and reading their reports. You're not truly a part of the decision making or anything like that. An SPV, pros are they take much smaller minimums. So if a venture fund, like let's say going direct costs you $100,000. Let's say going into a venture fund costs $1 million. And SPV minimums are much smaller, many times as low as $1,000. So if you want to be in the space or start to invest or be a part of it, SPVs are going to give you the lowest minimums than any of the other opportunities or options to get into investing into private assets. And so this allows you to take, $30,000 and invest in, let's say, 30 different companies. That 30,000 wouldn't allow you to even do one company going direct or one venture capital fund. But using SPVs, that 30,000 can be cut up 30 different ways, 30 different SPVs, 30 different startup companies. Your diversified portfolio is obviously pretty nice at that point. It also allows you to make decisions. You get to be a part of the decision making. You get to evaluate those investments. You get to pull the trigger. Like you're the one pulling the trigger. So the education is far greater than if you put it in a venture fund. Going direct is great education as well. And then there's opportunity for early liquidation options. You go into a venture fund, it's a diversified portfolio. Your money's attached to every single transaction. You do SPV, single asset. Any one SPV may get an offer to buy out your membership interest in that SPV. There's just a lot more flexibility with an SPV. There is cons. There is out-of-pocket costs to pay administrators. You don't get audits. You don't get financials. You don't get reports. It's a much simpler vehicle. And sometimes I hear complaints where it's deal by deal decision making. We're like, after those 30 investments, that was a lot of work. I got a phone call every day. I had to make all these decisions. I had to do all this due diligence. I just want to write a check to a venture capitalist. So there could be cons around not wanting to do the work, making those decisions. The SPV is the structure of a large number of individuals that are going into the private asset marketplace. Setting up a venture capital fund is difficult, expensive, long, arduous, and a lot of time commitment. So a large number of groups and individuals are going into the private asset investing world through SPVs. They're very affordable, they're very efficient, they're very transparent, and they're very well respected today. Wasn't the case maybe 10 years ago, but today, very, very, very well respected and accepted. So I'm just going to go through quickly kind of the anatomy of an SPV. A lot of people are like, well, what goes into this thing? And so I won't bore you too badly on it, but an SPV, you need to set up an entity. It's going to be like an LLC, a Delaware LLC or a Utah LLC. You're going to need an EIN number. You're going to need fund documents. You're going to need a bank account so everybody can, put their money in that, all those $1,000 checks that we talked about. You're going to need to sign the purchase agreements, right? So you set up this SPV, you set up a bank account, everybody puts their money in. You need to buy something. So that signing that purchase agreement is buying access to SpaceX or whatever asset you think is interesting. Then you send the money out, you wire that money onto the portfolio company. That's the fun part. That's perhaps the very stressful, passionate part of doing a deal, of finding investors, bringing in the money, making that purchase. And when you're done with that, there is kind of an ongoing stuff you need to do. There's good housekeeping. You have to do some security filings. You have to get everybody kind of a receipt that in the form of capital account statements. You have to make sure that you track everybody's information with regards to those that invested. So there's this housekeeping that you need to do. And then you have to do kind of this, we call it post-close, which is random, occasional stuff that pops up. So you're invested in a startup, things will just happen. If you're sitting on the cap table, they need everybody on the cap table to sign something. They want you to sign something. So they're going to send you paperwork. So you're going to have to review that and say yes or no, or sign or not sign, or have a lawyer look at it for you. You're going to need to do some taxes for these SPVs. Eventually, hopefully there's a great distribution. You have to send out distributions to everybody, and then you're going to have to shut the whole thing down. So there is this work, there are these elements, there's these anatomy parts of an SPV, kind of put them in these fun little anatomy parts. There's these 19 parts of an SPV that people will often ask, sounds interesting, sounds great, what's in it? And so there's 19 parts. They're not rocket science. They just need to be understood, and so you can understand what's going on. Going back to what I said, early at the beginning of this webinar, which was about the innovation that is happening. And so one seam inside this innovation is the structuring and administration. And so if private asset investing is going to explode like it has and continue to explode, one of those things that has to happen is make it easy as possible for people to invest. And if the minimum's always 100,000 to get in, how many people have an extra 100,000 laying around? And if you were to try to diversify and you want to do, 15 investments, who has 15 $100,000, laying around? Very few people. And so the innovation around the structuring and admin is what's driving a large number of less rich people, right? You have to be accredited. 200,000 is a lot of money. It's a great amount of money, but when you have $200,000, you probably don't have hundreds of thousands of dollars laying around just wondering what to do with, right? You may have $30,000, may have $10,000, may have $5,000. And so how do those individuals start to get exposure? And if all the alpha's in private assets, you can always go and buy Facebook or Microsoft or Amazon or whatever, Uber, now that they're on the public market, but all the alpha was in the private side. So if you wanted to be in that space, you wanted to start to participate in that space, you need an opportunity, you need some way to put in $1,000. And so the structuring and admin innovation that Assure and others have brought forward have made that possible, so that smaller dollar amounts can go in and you still can get exposure to these great opportunities that are out there. And so that technology piece that we talked about, the innovation and the technology, that 200 plus VC stack, Assure is part of that 200 plus stack. And we have a system we call Glassboard that basically takes all of those 19 aspects that I talked about, and we're digitizing it into like a digital back office, right? And an operating system for private investing. And so for us, we provide a technology stack where you just click some buttons, entities created, EIN numbers generated, bank account opens up, documents get created automatically, and people just click, sign, ACH their money in. And today at Assure, we can set up an entity and have a bank account open within 24 hours. Investors can come in, select, yes, I'm going to invest, and in under 5 minutes, maybe under 60 seconds, have said yes, signed, and ACH their money into the deal. So we have clients routinely, under 2 weeks, set up an SPV, raise a bunch of money, close, send it on to the company, all within a matter of days. So innovations around that type of speed and transparency is also assisting in the driving forward of investing into private assets. And so back on the topic of structuring and administration is setting up entities and then taking care of those entities. And there's a lot of groups out there, Angelus, obviously, Carta, Assure, innovation around standing up entities and providing great administration, professional administration, for a much lower cost, a much faster turnaround, a more transparent process that is helping grow that ecosystem and grow the number of opportunities, individuals, capital, and participants in the private asset ecosystem. With that, I'd love to take any questions. I think I see some, but let me.
Yeah, thank you, Jeremy. Are you able to see the Q&A box?
I can.
Perfect.
So when I read these, if we wish to create a blind pool of 7 to 8 individuals for U.S. investing in some U.S. non-U.S. startups, most individuals will be non-U.S. residents. We wish to invest in multiple assets, with each asset not being more than 20 to 30K. How can that be done? So that can be done in multiple ways. So at Assure today, we have a product that allows you to do an SPV for $4,000. So a $30,000 raise that goes into a startup company. This is a personal decision by the user of Assure's SPVs or other products out in the marketplace. I would say $4,000 is probably higher than you want, but it works, right? So you put $30,000, $4,000 of that 30 would go to Assure and the rest would go to the company. So you could get a structure and an administration product professionally done, fully baked, all in for $4,000. As your numbers go up, our price goes up a little bit as well. Like, we don't give $4,000 price for a $500,000 SPV, but we do have a product, at Assure. One of our missions is to help basically any deal that wants to get done. And when I say wants to get done, you have a founder that is that has interest from the marketplace. You have a founder that has set up a company, and then you have individuals that are interested in investing. And if those two things happen, we want to make sure that you don't say no to that money because structuring and administration is too expensive. There are costs there, so we haven't figured out how to drive that to zero yet, but we're getting close. We continue to drive that price down from what it used to be just 10 years ago of probably hundreds of thousands of dollars for an SPV, down to now $4,000 for the smallest raised SPV. Another answer to the question would be a multi-asset SPV, where you would put maybe, I'm not going to do the math here perfectly, but let's say there was $500,000 in that multi-asset, and then you start cutting it up into smaller pieces. When you get to the really small numbers, you start to run into structuring and admin issues, meaning the cost just can be a little too high. There's nobody out there that does it cheaper than Assure, more affordably than Assure. And we're trying to get that price even lower, but at some point, the numbers sometimes don't add up. So I think this question is on the bubble there. I think there's some other elements to that question. Non-US, US, no issues there. Non-US startups can be issues if you own too much of the company. So there's kind of some IRS stuff there, but our clients do US assets, non-US assets. Our clients have US investors, non-US investors. All those things are familiar to Assure. Sales@assure.co if anyone's interested in digging in and talking to the team about if we could provide services there. Moving on, next question. Is that back office Assure tech stack integrated with any other LP login, LP reporting tools? Answer is no right now. Our stack is API microservices based, so it can be connected, but we have not connected that up with anybody yet. So we have multiple opportunities with our services. You can get full service professional services. You can get very light professional services, or you can basically purchase the Assure tech stack by yourself and kind of build on top of it as well. Next question. In your experience, what would be considered a meaningful check from an SPV into a seed stage or pre-seed stage startup? So I think the question is, how much should I raise? And I kind of go back to my answer is, if the founder is interested and you have X number of dollars, then that's the right number. But a meaningful check, so if I'm going to read between the lines, a meaningful check from an SPV seed stage, over 100,000 on a pre-seed and over 250,000 for a seed stage tend to be more in the meaningful definition category. But we have people using our service for $20,000 investments into assets, all the way up to $50 million SPVs into opportunities. So on a general scale, it's kind of rough general numbers: 100,000 for a pre-seed, 250 plus for a seed stage. But again, it's really between you and that startup company. Next question. If your sponsor will be making distributions quarterly or monthly from an investment, like an income producing dividend, real estate, something like that, is the SPV the right wrapper to pool small investor checks of 50 to 50K? An SPV can be used for anything, any sort of asset. The SPV is a perfect wrapper for pooling investors that are going to invest into a private asset, even if there's going to be distributions. There's really no difference between an SPV structure from a VC fund structure. The real difference here is, are you going to put one asset, multiple assets? What's kind of that admin thesis that you're going to put around this vehicle that you are putting together? So we do have SPVs who go into income producing, dividend generating assets, and the distributions come out. The difference there is you have to bolt on additional services like a distributions service, typically of financials, because if you're going to have money move that much, you're going to want to track it. You want to have probably financials. So you'd want to bolt on some additional services, but there's nothing wrong with an SPV being used going into an asset that is high distribution asset.
All right, wonderful. Do we have any more questions? It looks like you answered them all. Thank you again, Jeremy and Assure. While we're just waiting.
Another question came in.
Oh, perfect. Yep, go right ahead.
Would an SPV structure be appropriate for an $80 million VC fund made up of multiple family offices? In other words, could you use an SPV structure but behave like a VC fund? On the behavior side, so if the behavior is going to be a VC behavior, then VC is the correct structure. So I'll explain a little bit. I'll run at it again. An SPV structure is the exact same structure as a VC fund. And what I mean by that is I talked about those 19 anatomy parts: entity, documents, EIN number, purchase agreements, security filings, capital account statements, distributions, all of those things, all those 19 parts, they're the exact same parts that you'll find in a VC fund. They're identical. The difference between an SPV and a VC fund would be that some of those anatomy parts are accentuated or not accentuated. So a VC fund is going to have far more administration around financials, due diligence, audits, taxes are going to be far more complex. And so because of all that complexity of that VC fund, because of, we're going to pool this money, we're going to invest in these types of assets, we're going to, put 50 investments into this VC fund, we're going to reserve capital for follow-on investing, we're going to, XYZ, ABC, all of that turns around and requires administration, capital calls, quarterly NAV packages, year-end audit, year-end financials, monthly reporting, all of that admin stuff costs money. Therefore, you need to build a team. You need to have a management fee, all of those things. So a VC fund and SPV are identical structure-wise. They're not identical when it comes to administration. VC has a lot more administration. You need to pay for that administration, either an in-house team or third parties like Assure to take care of those needs. So if you ran an $80 million VC fund made up of multiple family offices, that feels very VC, feels like you should do a full VC. I'm just going to throw out a twist. If you had family offices that say, we want to do investments, and they wanted to just go deal by deal, then you could do 50 SPVs. And the total when you're done is $80 million worth of AUM in those 50 SPVs. You can do that. You can do a $80 million VC fund, and then you can do sidecar SPVs alongside. Some clients of ours are raising not the 80, they're raising 30 million, and they're going into the deals. And then that remaining 50 million comes into the form of these sidecar SPVs from the family offices who are making deal by deal decisions where they're like, deal one was okay, but I didn't love it. Deal two, I love it a lot. I'm going to double down and put an extra 5 million into the sidecar SPV into that deal two. So we're seeing a lot of variations and behaviors around these different structures where they're combining together, mashing them together, and using them in a lot of different ways. Okay. I think that's it on the questions.
Perfect. Yes. Thank you, Jeremy. And thank you, Assure. Thank you to everybody who sent in questions and joined us today. Once again, if you missed it at the top of the hour, I will just say you can find the recording of this entire webinar at utahbusiness.com. Within a couple hours, it will be posted there. And yeah, thanks everybody. And I hope you have a great day.